Okay, my name's Tyson Halsey. I'm the president of Optima Process Systems Inc., which is a energy startup. Also, I am the managing member of Income Growth Advisors, and I do investing. And we have a very and it's interesting because I have a perspective on energy that is both the public as well as the private end. We have a great panel today. We're going to start off. I'm going to make the intro, and then David, you start. We'll be starting with David Allen, who is a world-class investor, and he's going to give an overview of the energy space. And then we'll follow up with Kim Getkin, who is doing something that everybody is interested in, and that is a actual tool using artificial intelligence in the energy space. So how we can actually use AI and apply it. Uh, and will be followed by Victor Sowers, but I would actually refer to this as ping pong. Victor Sowers has spoken here, a brilliant man involved in a variety of energy assets or energy businesses, but also in the electronic space. He's out of Texas. And what I think that will occur, or I hope will occur, is there'll be what we call ping pong between Kim and Victor. Victor has, and I believe still serves on the board of ERCOT, the Texas public utility, and he can go back and forth because some of Kim's applications relate to that. And I think that'll be very interesting because then we can see some real applications of artificial intelligence used in the energy space. Then Bate will speak and will give us an update on what he is seeing. And he runs EP Valuations, which values energy assets. So anyone wants to sell anything, give me a call and Bate will be glad to value it. Or you can call Bate directly and he can help you value it. But we're always happy to be involved or help anybody in any of these applications. So, David Allen, please tell us, what do you see in terms of energy alpha opportunities? What do you see in the energy field
Very
today?
good. Thanks very much, Marty. Thank you so much for having me and us. I'm honored to be on this panel. And I promise you, I'm going to go through the slides quickly, and I'm going to hand it off to Kim and Victor because that's going to be more exciting. But this is a perspective. I left Schroders about a year ago. I founded Octane, and the reason I founded Octane was half the world, implausibly, doesn't think that we need traditional energy. And I beg to disagree. And so this is Finance 101. I started a company to fill the gap because we need more, not less traditional energy. Let me share my screen and we will start walking through my slides here.
Okay, you know how to
So,
change the view on that? There you go. Yep.
yes, thank you. So this is a really seminal slide, and basically it says the pretensions around GFANS, Glasgow Financial Accord for Net Zero. I'm sure everybody in this audience has money managed by one of the 317 firms that have still signed up for GFANS. But slowly but surely, the paint is running on those promises, and I think it's good because the sooner we get real about real energy, the sooner we can have an adult conversation about it. And it wasn't just November 5th. We're not just talking about politics, ladies and gentlemen. We're talking about physics. And let's remember, there's 30% of the SP 500 is Mag 7. There's no Mag 7 without reliable, affordable power. I see Victor smiling. Thank you, Victor. On the
Very
next
true.
slide, what's that?
Very true.
Yeah, thank you. On the next slide, what we've done is, on the left-hand side, we talk about supply of capital. Supply of capital has generally gone down. By our rough count, we think that about $50 trillion of allocator assets, this is outside of GFANS, this is Paris Accord money, have either already divested of traditional energy or plan to between now and the next 5 or 10 years. It's also true that volatility has kept generalist investors away from the oil patch. Let's face it, it's a scary, volatile place, completely dependent often on a commodity that's in itself volatile. And that, combined with the fact that we now live in a passive world, passive passed active in 2022 with mutual funds and ETFs. It's now only, energy is now only 3.5, 3.4% of the S&P 500. Since 87, it's been between 6 and 16%. Is it the energy sector? Now it's less than 4%. In 1980, it was 27%. So we think that the industry is being starved of capital. More importantly, on the demand side, this first thing that I've circled is, I think, the most important. There are billions and billions of people there. I think there are 3 billion people in this world that use less electricity than my refrigerator. And, there's a way to end that. And the way to end that is to smartly and cleanly export some of our hydrocarbons. And I'm sure that we can get to this presentation, but I'm going to rip through this. Now, there's not just GFANS, there's also the Net Zero Banking Alliance. And what's fascinating about this slide is even names such as JP Morgan and B of A, who have been relative voices of sanity when they're called up to Washington, have still agreed to lower their lending intensity. That's why we're going to start a credit division soon as well. We're going to sell to insurance companies, because here's another part of the capital market system that wants to starve traditional energy of capital. And we don't think that's right for human society or our civilization. Here's a fun story about coal. A lot of allocators, including New York City pension plans, have said coal's a stranded asset. You can't invest in coal. Well, what's interesting about it is, we own a Pennsylvania coal company, and only 6 years ago, it had 1/3 of its revenues from seaborne coal. Now it's 2/3. These people aren't dumb. They're not sitting on their hands. They're actually saying, where are the markets? Let's export them. So I'm sitting in Times Square with a big company, big multimedia company, and we're talking about coal. And this person didn't really know much about coal. She says, oh, well, I guess India's taking up the US slack. And she said, well, where's China in all this? I said, hold my beer, hold my coffee is what I said. I mean, my goodness, I'll go back. There's India, United States, and there's China. Now, the funny thing is this gorgeous iPhone was certainly built using dirty brown sulfurous China coal. And I bought it for $800 and I love it. If I had to buy that in Silicon Valley, I'd pay $8,000 for it. China needs more hydrocarbons. They're huge. I know there's been a pause with their oil demand. Huge importers of LPG, LNG, coal, and hard coal, coking coal. They're getting hard coal, which is needed for steel. They don't have any hard coal, so they get it from Canada, Australia, and the U.S. It's another interesting angle of attack for us. So, how does a value lens interpret the energy sector? Well, if you're a generalist investor and you have a dollop of capital in S&P 500, then by definition you have what is in the XLE, which is the subset of energy stocks in the S&P 500. By the way, the XLE is a great, they only charge 9 basis points, run by State Street, $38 billion. If you want to top up your energy exposure, just go buy some XLE. It's broad exposure. The thing is, 40% of the XLE is in 2 names, ExxonMobil and Chevron, certainly great companies. But when we take a value lens and we look at the energy complex of stocks trading in the US, including ADRs, we want to underweight the US integrateds. We want to overweight some, not all, but some of the European super majors because they're trading at really nice cash flows right now. And we're not into home runs. We're into bunts and singles and sometimes a double. Regarding transport, normally we'd say, okay, that's midstream, but I want to call it transport. We're underweight midstream compared to the average energy investor, specialist investor, or even the subset of securities in Russell 1000 because they're wonderful businesses and they are valued that way. The basket of tanker stocks that we own are trading at about 5 or 6 times price to earnings. They're trading at an NAV discount of 30%, and they've got very good balance sheets. So that's why we really like them. Last but not least, coal. We've got almost 20% weighting to coal. It's re-rated a little bit, so we may take some chips off that table. I can't talk to you guys without covering the most important commodity in the world. This is a WTI chart. I took the snapshot yesterday, and I was an FX trader for the first 1/3 of my career, so I have to be a technician. And this is a really interesting pennant. It looks like this thing can go $15 higher or lower overnight. The front month may go to $50, but we don't think so. What's keeping it down? The threat of OPEC plus supply overhang. That's a reasonable threat. And more importantly, more topically, lower Chinese demand right now. We think we're going to come out of that trough. What's holding this market up? Well, people ask me, what about the new administration? What about November 5th? We don't think, just look at the Biden administration, we don't think policy people in DC can necessarily change production that much. What governs production? We think it's these things. It's geology, technology, price of the commodity, and cost of capital. And we look at those four. We talk to people in the oil patch, CFOs, operators. Stuff's not getting any cheaper to get out of the ground. We notice tier degradation. So they're going into, second tier acreage. And there's only so much. The technology has been brilliant, but we may be pushing on a string there. So all else equal, we think that there's a decent floor here. And we think that when you combine geology with cost of capital, we think there's a natural range, $65 to $85, $65 to $85, $90, $100. There is a whole lot of acreage that becomes profitable again. So here's a little fun, and this is how I'm setting up Kim and Victor. Which of these four stocks in the last 12 months is NVIDIA? And which are the merchant power stocks? And I'll reveal it in the next slide. The fun part about this is the market in the last 12 months has truly recognized that this civilization, this market, our country needs power, reliable, affordable. November 5th, I think, was a strong signal about that. But what's interesting is the market has finally woken up. Now the five-year chart, NVIDIA destroys all these people. But in the last 12 months, the market has really taken note of these merchant power stocks, right? They can produce energy, sell it in the market. They're not constrained by vertical geography and municipal rules. So here's which stocks they were. You can see it in this, and I'll send this PDF to Marty if you'd like this. But I'm going to end with a quote from Arjun Murthy, who is a really smart observer of the markets, and he's a former Goldman partner. And he said this three-level syllogism. He said, syllogism. One, software will continue to eat the world. Mark Andreessen said that. Two, software runs on hardware. And three, hardware needs reliable power. So that's my segue over to Kim and Victor. Thank you very much.
Thank you, David. Kim, you want to go first? Ladies first, the way I was raised.
No, please, guys, go for it.
All right. So the way we see it from the various presentations for the last day and a half, we talked a lot about data centers, other technology, medical, what have you. The way we see it, because we're right in the middle of it, to give you an idea what TCO Energy Capital does, we work with over 250 utilities. We work with all the energy technologies in play, and we also do an industrial assets such as semiconductor, oil and gas, and generation, both. So what do we see? We see right now in the marketplace where on the generation side, we got 2.6 terawatt that is backlogged. And to segue from David's presentation, when we see where's the play, where's that next 5-year play, what is the smelling of the roses looking like? And a canary in the coal mine was EV charging stations, where you saw that EV charging was becoming more difficult. And so you had somebody like Ford, Rivian, and also GM saying, let's use a Tesla charging station. And the answer is why? And they say, well, because we can't get our load request. And then all of a sudden, Tesla lays off every single person in their charging division. Why? And so the canary in coal mine is that the distribution system, which is separate from the transmission system, is full. So what do you do about that? And then we have hyperscalers coming in data centers asking between 300 megawatt up to 2.2 gigawatt of power. So with those kind of things in play, even outside of hyperscaler data centers, we're also seeing reshoring of manufacturing at a mass scale that is heavy loaded, that we see they're asking for power just as much. So when we see the plays coming in at, let's say, Domain Energy, which is your Virginia, West Virginia, Maryland, which is a large data center, and Texas. Texas has 19 gigawatt of load under construction. What I mean by that, it's not the wires, not the generator, it's the buildings, it's the manufacturing, it's the data centers that's currently under construction waiting for a wire. That is the steepest rate that any state, or for that matter, Texas, has ever seen within the next 18 months of load. So you can imagine what that is. It's massive. So then we talk about nuclear power. What do we have in nuclear power? So the DOE says that we need 60 times the current nuclear power than we have. So right now we have like 33 nuke plants in play. If you double that, that's about 2,000 nuclear power plants. And we don't know if they're going to be utility scale, gigawatt, or these SMR, small modular nuclear reactors, or another one in play that we like are the modular nuclear power plants. That's big play. You have about 5 gigawatt of MOUs contracts that oil and gas and data centers are contracting with these micro nuclear power plants. That's huge. So, and also the hyperscalers are also contracting fuel because they don't think the utility will be able to play ball or get them wire for the kind of scale that they're going towards. And right now there's 3 billion per day. So CF per day that's on the contract. So they're going to generate power somehow. The data centers are going to say, you know what, we might have build a power plant somewhere and run our own wire. That happens all the time. But this is massive scale. So right now, between outside of Texas, if you're in the FERC territory, which is the other 48 states, how can you get a wire? It takes 12 years if you're lucky. Not going to happen. So between the distribution system being full, the transmission, which if I run an intrastate wire, it costs just as much for me as building a power plant. So why do I want to pay twice when I'm going to build on site? And it de-risk it because right now the utilities, the GMs, CFOs, and are saying, you know what? That's a lot of power that we're going to be holding to. That these guys go south. That AI is really a .com bust because they're not sure of how they're going to make revenue and be sustainable in the long run when they do 7-year, 8-year fuel contracts for their customers. Who's going to hold the bag if a data center goes south within their territory? So they're very, very concerned. But at the same token, to seeing all this manufacturing coming on and data centers coming on, and they want to capture that revenue. They all want to grow revenue, but not at the risk of losing their capital stack. It'll get blown out terribly. So they're very, very concerned on a data center that is just a long-term play or short-term. So clearly it's pretty heated right now. The utilities are scared to death. They can't get them a wire without enormous amount of cost. And even if the hyperscalers or high-tech guys, the big five, paid for their own wire, then they're expecting the utility to provide the power. So that's a high risk. So relative to technology coming into play, if you knew Google was going to be where it is today from start, when its very first $100,000 investment to where it is today, what would you do for that 10-year outlook? And we most likely see that the modular what we call micro nukes will probably come into play very strongly. We see a lot of the fuel type, the technology coming into play where they can come in about 6 cents a kWh, and some of the technologies coming in less than 5 cents. So that is their cost to operate. On the CapEx side, we see possibility where the under 4,000 per kW. That's how we calculate cap. So what does that look like? And say, hey, you know what? It's affordable for industrials to have their own power versus putting the utility and the customers at risk. So that's how we see that kind of area. So clearly I can speak an hour and a half on this. So I put my email in the chat if one of the members, viewers want to have a further conversation, either on the technology side or how this power side is going to play. So with that being said, you're up, Kim.
Thanks, Victor, and thanks, David. So I'll give you more of the perspective of like why would an entrepreneur start a company, focus at the energy space and innovation. And I think Victor and David just gave the reason why. And I'm not often able to say that because I'll say raising money, I'm in a pre-seed round mode. And as I go out and raise money from folks that are looking for clean tech investments, they understand the energy space. If I go out to the AI and the SaaS players, what I often hear is, why did you pick energy? Why do you want to sell to utilities? We're out. And they literally tell me they're out because of the fact I picked the energy industry. The energy industry is essential to our human development, whether you're in this country, if you're in Africa. In fact, we already, as a pre-seed startup company, have a customer in the Philippines. So, if we're not going to take it seriously, we as an early stage startup are we've got customers in Canada, we've got a lot of interest in Europe and also in New Zealand and Australia. So I think, the point for me was, if you look at the evolution of innovation, power has been at the heart of it. The scientific method and design thinking framework that we're actually modernizing in our SaaS platform is a cleaned up version of what Thomas Edison did. Thomas Edison was the one who told us and demonstrated that the way innovation works is in ecosystems. We have to collaborate. And never before in the history of modern technology is it easier to do that, because we have SaaS to scale and we have social media platforms to be able to collaborate, LinkedIn and others. So taking all of those pieces together and saying, okay, how are we going to move past some of these problems is really to get the energy innovators, those smart engineers who I spent a lot of time working with, solving these challenges. And whether you want to go for coal or not, whether you want to go for a wire or a non-wire alternative, whether you're helping your customer that's a large CNI customer like a data center, build a wire or backup generation, or you're helping them put on-site renewable power, whatever side of the fence you're on, and I bet it's going to change a bunch, innovation is going to be your key to get you out of it. So, I feel like we're a sure bet. So I just wanted to share a little bit about that personal piece of my story and my founder's journey, just because it seems like this group gets it. And not everyone gets it. And so, innovation is not going away. Innovation has been very complicated. Innovation has been traditionally hard for the energy industry because of all this complication and the regulated nature of it. But what I'll say is, it's so interesting and humbling to have the opportunity to work with these engineers that I deeply respect, that are at our utilities today, that are the ones that are figuring ways out of these problems that we are faced with, to be able to deliver not just clean, but the affordable, reliable. And so I am very bullish on the future. Heard a lot of talk about SpaceX this morning. We've got a SpaceX, we have a right here. The grid is 7 million miles. It's the greatest invention that mankind has ever created. 7 million miles is like going to the moon 15 times and back. So let's invest in our grid. Let's invest in our infrastructure, right? And I do think that there is a lot of money here to be made, regardless of politics, or if we end up putting a wire in the ground and then having to find a non-wire alternative later. Innovation is the cycle that is going to keep solving the problem.
Hey,
Hey,
Kim.
Kim, you know what? For everybody listening on the Zoom call, what Kim has made is a library of technology that engineers at facilities can, utilities use. Here's the deal. Utilities, it's illegal for utilities to do innovation. So everything that we've seen between batteries, high voltage DC power, wind, pick it, doesn't matter. They're not allowed to touch innovation. Their vendors can, right? But the engineers at utilities are typically understaffed, multi-hats, and they don't have full access or time to be able to see everything is out there. What Kim has developed is a library of information where a utility engineer can say, what's the best why, what's the best reclosure, what can we do about this situation, and to be able to identify it. It's basically, it's a great tool for the utilities to find a solution that otherwise they wouldn't have time or an understanding of what works, doesn't work. Is that correct, Kim?
Absolutely correct. And so the marketplace of ideas, the challenges are being generated by the utility. And the challenges that get generated are from publicly filed documents. So the one thing utilities are great at is we're regulated. So they have a ton of paperwork. And in that paperwork are the keys to their roadmap. And even the people who work at the utility, they may write the documents, but they don't always have time to read them all. So it's perfect for AI. AI can crunch through all of that and literally tell the market, here are the missing capabilities that we need to be able to solve challenge X and challenge Y. On the other side of that marketplace are the suppliers. Now the suppliers don't have time to read all of that either. So they come to our marketplace to say, hey, we have a newfangled sensor to be able to help you mitigate a wildfire risk. Guess what? The AI that we are developing in the next 6 months, which hopefully will be funded in part by Department of Energy, will match that solution provider to the utility with the actual budgeted need to solve that problem. And so by being able to match people in seconds, challenge owners who don't have time to generate their own challenge statements, but they want to be nudged, and suppliers that actually have a viable solution to the problem, they get notified, and in seconds, right now, we could start to move pilots faster. The supplier also provides a manufacturer recommended test plan as part of their use case. And so now the utility in one click can adopt that entire idea with the test plan ready to pilot. The only thing I can't fix is procurement. We're trying to work on that too. So the procurement office gets comfortable with this and can easily, and maybe even one day, transact on the platform so you can buy pilots quickly. So we're trying to take out all of the friction and get pilots to field quicker. And then, of course, the workflow also gathers all the information that comes back from those engineers from their field trials, and then allows the utility and or the supplier to share that back into the open ecosystem so they can prove that they had a successful pilot. And to reduce risk in all of this, this is what utilities ask me for all the time. They have to reduce risk, so they need to know that somebody else in the ecosystem has already solved this problem. So if we can help show them that, then they can more rapidly adopt some of this new technology. And some of the new technology that I see backing up is AR, VR, 5G, a bunch of AI ideas, wildfire mitigation, a bunch of virtual power plant software, DERMS and software controls. So if we can help all of them learn from each other, we can reduce the risk and then move more of these ideas into production so that we can find the wire or non-wire alternative depending on what you need in your particular service territory.
Hey, Kim, for people who didn't see you present yesterday, can you give an overview of your company, Innovation Force, how it works, how much money you're looking in this seed round, what the valuation is, and whether you have any revenues and customers?
Yep. So we're in our pre-seed round. We've raised $1 million against a $2.5 million target. We have 2 multi-year enterprise SaaS agreements, one with Portland General Electric, and the second with an R&D hub called CIATI. CIATI has put 155 utilities on our platform to build this ecosystem. CIATI, and we are in talks to be able to white label our solution through them next year, where they would basically convert their members into enterprise software SaaS contracts for us. So what we're projecting is 3 million in ARR next year and 10 million following through that partnership. So we are looking to raise another 1.5. We've raised $1 million, and we've done 2 million since I've started the company in revenue. So did I miss anything there? I think, Tyson, did I hit all the key points?
What does, how much ownership
We're
does
raising
$1
on a
million?
safe, I should have said, yeah, so we've been raising off of a safe to date, for that million. We've been raising off of a safe it's a $10 million valuation cap on that safe. So that has been the fundraising vehicle. If I'm looking to raise 2.5 total. That will get me to my milestone of 10 million in ARR, at which point we would be cash flow positive. And so we should have, fingers crossed, $100 million valuation or more off that $10 million of clean ARR. And then we'll decide, what do we want to do? Do we want to go from our pre-seed round to seed and scale this thing, or, do we get acquired?
So $1.5 million gets you 15% of this company.
Correct.
At a 10 million valuation, and things go well, it could be 100 million.
That's the goal by 2026. By end of 2026, with this distribution channel partnership in place, we should be at 10 million ARR and $100 million valuation.
And what is your website?
Innovationforce.io. And my co-founder is Harvard Business School professor, Dr. Linda Hill, who wrote the book Collective Genius, which proves out this whole need for ecosystem innovation. 3 million views of her TED Talk, and her next book called Scaling Genius, which will be on the front cover of, through Harvard Business Review, will be out next year. So it'll be a great marketing vehicle for us.
Please leave your contact information in the chat. Let's go to Bate, and then we'll come back with more questions for Kim. How does that sound? All right, Bate, fire away. You're muted. I don't know why you're muted. It doesn't look like you're muted. I can't hear you. Still can't hear you. That's curious. You want to drop out? There we go. Oh, wait, no. I thought I heard somebody. We can't hear you. We can't hear you. I would.
Bate, relog on.
Bate, you have to relog on. We can't hear you. I'd log out and log back in. Kim, anything else that you forgot to say while we're waiting for Bate?
I could make a big announcement. Inc. magazine named us Best in Business for 2024 this morning. So we're one of the 240 companies.
Did you say you have revenues now, or just those?
We've done 2 million since we started around the end of 2021, 800,000 in contracted annual revenue this year, approaching 1 million. And then, like I said, through this new distribution channel, through our customer, we will hit 3 million in ARR next year and 10 million the following.
Bate?
All right. Yeah. Am I?
Yeah, we can hear you.
Excellent.
You sound much better that way.
So, well, it's good. It's good to be here. Thanks, Tyson, and David. Good to meet you, and Victor, and
hello again.
I'm going to take a slightly traditional route, and I was going to talk just kind of highlights on the oil and gas space. So, EP valuation we do two things well. We do due diligence and asset valuations. Most of the work we do is for capital providers, occasionally for operators, but generally we support capital providers, banks, family offices, private capital. In terms of debt issuance, investments, and other similar transactions in the marketplace. We're based in Texas, but the clients we support and the deals they fund all over the United States. So we see a very decent amount of deal flow across the energy space, especially oil and gas, which is what I'm going to touch on. Just, directionally, I would say, as you all know, we are as of last month or October, the US hit 13.5 million barrels per day production, which is the highest on record, right? So that is good directionally. On the other hand, crude inventories at Cushing are 30% below the 5-year average, right? So that points to what David was mentioning, kind of a pressure on pricing. And to add to that point, in June of 2020, at the height of COVID, there were almost 9,000 drilled but uncompleted wells, the dock wells, right? So those are in this business the easiest and fastest levers you can pull to bring more production to market. As of last quarter, there are only 4,500 of those, so we're half the peak, right? So what that means in late terms is, if you need new production to support sustained demand, you need to put in new capital to work. And this for an industry that finally found religion in terms of capital discipline, right? So we blew a lot of cash. We finally discovered return on investment as opposed to growth for growth's sake. And companies don't want to put too much money out to work unless there is a premium on that capital. So I would expect oil prices to see a pressure upward because of these three dynamics moving together. On the other hand, gas is a slightly opposite story, right? Because gas prices are soft, storage is above the 5-year average. And if policy changes as the new government comes in and Mr. Trump is able to essentially resolve the Russian-Ukraine conflict, so to speak, right, in some fashion, and you see Russian gas going back to Europe, then you would expect US gas to soften even more, right? Because that is at this point the primary driver to move prices up for US gas, absent a really severe winter, of course, right? Because the US is competing with both Qatar and Mozambique on a smaller scale for LNG exports, right? On our side, it's a long-term thing to do. On the US side, not impossible, but Russian gas returning to Europe would definitely put a dent in that process, right? Gas prices would be softer. Having said that, I think if you look at just the oil and gas companies in the market today, right, there are fewer because 23 was a really banner year for M&A activity. So you have fewer companies in the market, and based on the data we see, there were 50% fewer issuances of debt in 2024 compared to 23. So companies are asking for less capital. 1, because they're cash flow positive. 2, because there are fewer of them. 3, because they finally found capital discipline. And 4, because they're not deploying as much money as you would expect for the level of activity you expect, right? So all of that says, again, that directionally 25 should see a gradual increase in oil prices, because once you get past this production peak, you need new money to bring new barrels to market. That's one. The second is that because of good technology, which has been mentioned already, my clients are able to do more with less. So rig counts about 500 rigs running right now, which is not a high, it's I would say medium low for the industry. 20% of those rigs are chasing gas, 40%, 80% are chasing oil. But even so, our clients are drilling faster and even drilling into tier 2 and tier 3 rock, right? But making the kind of returns that we used to see 5 years ago in tier 1 rock. And so as prices go up, we get the kind of return on investment from poor rock that we didn't have before, right? So which brings this new outside the bounds into play, so to speak. So there's more oil potential that can come to market as prices go up and as technology reduces the cost curve, right? So if you take gas out of the picture, I see a very strong energy market going forward.
I have a question for you.
Yes, please.
So what we're seeing in our oil portfolio and also our clientele, we're looking at 3 to 4 mile lats, horizontals.
Yes.
So my CapEx is a lot less and the decline is not as severe. What are you seeing?
Well, that is correct. And that's kind of what I'm alluding to. So you can do more with less, right? You drill you set one rig, you drill what used to be 3 wells or 2 wells, right? You get a similar recovery on a per foot basis, right? In terms of production, because completion techniques are so much better now. And, the decline is not 80% anymore, right? Because we're better management, production management techniques. So that's my point, right? So if you're going to bring new barrels to market, you need to do so with new capital, right? But you don't need as many rigs to get that done.
Let me ask you this, since you probably have a lot of focus in Texas, the oil capital.
This is the last question, guys.
My question for you is so West Texas needs about 4 to 5 gigawatt of new power, but the generation capacity is not there.
Right.
So, and on-site generation, which is diesel generators, and is about 2 gigawatt of diesel generators current running in the patch. That's changes the OpEx significantly.
Materially changes the OpEx, yes. So what to do? Is that your question?
Yeah, what to do from your perspective?
You know, some of my clients are talking about pushing the legislature to change the rules so that oil and gas companies can have on-site generation without becoming utilities in themselves, because that's the primary limitation right now, right? If that happens,
they can do it. They can do it for under 10 megawatt.
right.
Anything above, then it gets a little sketchy.
Correct. And so that's one. That's what some of our clients are talking about. The other is they just have to wait, because ERCOT has a list and they're not on the top of that list at this point, right? So they'll have to wait for power to get to them. Because there's no magic to this process. Either you use diesel or you wait, or they change the rules to allow our clients to build their own power generation. You know, I think keep in mind that most oil companies really do not want to be in the power business. They're considering it because they have no choice, because their demands have grown so much that they have no choice. I'll give you an example. Over the past year, we talked to my firm represented a few crypto mining and data center companies who are trying to get stranded gas or low price gas to run the engines. Well, we found the gas, but we could not get the revenue sharing agreement to make sense to all companies. So they didn't go for it. Right? One client actually told us, we love crypto, but we cannot fight that battle with them. We just can't ride that horse. They either take the gas or not. We can pay for the pipeline, but it needs to be an outright purchase contract. So they actually now prefer data centers, large data centers that can consume their product for a long period of time, because then they can build CapEx into that contract.
So, we gotta go. Great job. Thanks so much.